Best CD rates for April 30, 2026. Lock in up to 4.34% APY before rates drop. The landscape for certificate of deposit CD rates is shifting as the Federal Reserve continues to lower interest rates. As of April 30, 2026, savers can still secure competitive yields, with the highest available rate reaching 4.34% APY for a 5-year term. However, with expectations that rates will gradually decline, now is a critical window to lock in current yields before they fade. CDs remain one of the safest vehicles for growing savings, offering guaranteed returns without the volatility of the stock market. While the era of double-digit interest rates is over, current offers still significantly outpace traditional savings accounts and checking accounts, making them an essential tool for conservative investors. Top picks and current market leaders for those looking to maximize returns immediately. Advantial Federal Credit Union stands out with its 5-year CD offering a 4.34% APY. This is the highest rate currently tracked, though it requires a substantial minimum deposit of $50,000. This tier of accounts, often called jumbo CDs, typically demands higher capital in exchange for superior yields. For savers with smaller budgets or those seeking shorter commitments, other institutions are offering strong alternatives. Best overall value, low barrier to entry. E*Trade offers a 1-year CD at 4.1% APY with no minimum deposit. This is ideal for investors who want competitive rates without locking up large sums of capital. Best short-term option. United Fidelity Bank leads the 6-month category with a 4.2% APY. This compares favorably to the national average for 6-month CDs, which sits at a much lower 1.66%. Why timing matters. The Fed's influence the direction of CD rates is inextricably linked to the Federal Reserve's monetary policy. The Fed has cut interest rates 3 times this year, signaling a clear trend toward a lower rate environment. What this means for you: gradual decline. As the Fed lowers its benchmark rate, banks typically follow suit, reducing the interest they pay on deposits. Short-term volatility. Short-term CDs, 3-12 months, are likely to see the most immediate drops in APY. Long-term stability. Long-term CDs, 3-5 years, may hold their rates longer, but new offerings will likely be priced lower than recent highs. Key insight. With rates hovering around the 4% mark, many financial experts suggest this may be near the peak of the current cycle. Locking in a rate now protects your savings from the inevitable decline in yields over the coming months. Potential earnings. How much can you make? To illustrate the power of compound interest in today's market, consider a standard deposit of $50,000 placed in a 5-year CD at the top rate of 4.34% APY. Total interest earned: approximately $11,833 by the end of the term. Comparison: this return is substantially higher than what a standard savings account would generate, highlighting the value of locking in funds for a fixed term. Strategic approaches to CD investing. Choosing the right CD isn't just about picking the highest number. It's about aligning the product with your financial liquidity needs. Here are 3 common strategies. CD laddering. Instead of placing all your money into one long-term CD, split your savings across multiple CDs with staggered maturity dates, e.g., 1-year, 2-year, and 3-year. This provides periodic access to cash while maintaining higher yields on longer terms. Short-term lock-in. If you believe rates might rise again, though current trends suggest otherwise, a short-term CD allows you to reinvest at potentially higher rates sooner. No penalty flexibility. For those unsure about their cash flow needs, no penalty CDs offer the security of a CD with the ability to withdraw funds early without fees, though often at a slightly lower APY. Understanding CD terminology. Navigating CD offers requires familiarity with key terms that affect your earnings and flexibility. Add-on CD allows you to make additional deposits after the initial funding, unlike standard CDs, which are closed after the first deposit. Brokered CD, issued by a bank but sold through a brokerage firm like Fidelity. These often provide access to higher rates or unique terms not available directly at local banks. Bump-up CD Allows you to increase your APY once during the term if market rates rise, offering some protection against falling yields. Share certificate, the credit union equivalent of a CD. These are insured by the NCUA rather than the FDIC, but offer similar safety and returns. Frequently asked questions: what is the highest paying CD rate right now? As of April 30, 2026, Advantial Federal Credit Union offers the top rate at 4.34% APY for a 5-year term. Are 6% CDs still available? No. The current market top is 4.34%. While limited time promotions can occasionally spike rates, 6% APYs are not currently available in the mainstream market. Can you lose money on a CD? It is rare, but possible. You are protected up to $250,000 per depositor by the FDIC for banks or NCUA for credit unions. Losses typically only occur if the institution fails and exceeds insurance limits, or if you withdraw funds early and incur penalties that exceed the interest earned. What should I consider before opening a CD? Evaluate the term length, interest rate, minimum deposit, and early withdrawal penalties. Always verify if the institution is insured and whether there are membership or geographic restrictions. Conclusion: with the Federal Reserve signaling further rate cuts, the window for securing 4% plus APYs is narrowing. Savers should act quickly to lock in current rates before yields decline further. Whether through a high-yield jumbo CD, a no-minimum entry account, or a laddering strategy, CDs remain a vital component of a balanced, low-risk financial portfolio.